So good evening, everybody. Thanks for joining us today for our webinar. Uh, Today we are talking about yet another component of finding the winning stocks. These are what we're talking about today is mainly the institutional sponsorship, which basically the I in Cancelim. We talk about why it's important, how it is that the institutions drive stocks in the market generally, and we'll see that in the chart as well, where we can see heavy buying and heavy selling volume that is caused mainly by institutions. Uh, so first of all, before we start today, please have a look at this disclaimer. Uh, so the content in this presentation should not be used as a recommendation to buy or sell. Uh, Whatever we talk about here, we are just talking about our methodology that we use to pick stocks, and hopefully you learn something from this methodology and you will be able to apply it on your own when you do your own research. So always do your own research before buying or selling any stock. Yeah. So before we start with the presentation, we'll talk a little bit about what the market did in the past 2 weeks, as well as how our model portfolio has been doing. And we'll talk about some new developments as well that happened in the few weeks.
So hi guys, Siddharth here. So as Arun told, we'll first give you a quick update on the market. Our portfolio has given 27.63% returns since the beginning of this year, and we have generated an alpha of 10.4% against Nifty. And we currently have 20 stocks in our portfolio. So over the last 2 weeks, the major uh, market moving factor was obviously the GST. As all of you know, it's a landmark policy undertaken by the government, which is going to be implemented from July. Now, the important thing to note is GST is just one cost component of a company. That it's the tax component, and it's one of the cost components of the company, and it doesn't necessarily mean the company will become good or bad overnight. So there is a lot of coverage on GST and how it will impact different sectors and stocks by recommendations, but we still suggest that you still look for quality stocks and not purely go on just one tax component in the economy. So this one, as this was a positive news, it pushed the broader markets and benchmark indices. As you can see, last 3-4 days, the Sensex and Nifty, they're hitting all-time highs. The Nifty has crossed the 9,600 mark, whereas Sensex has reached scaled more than 31,000. So let's learn a little bit about GST. So GST is basically a uniform tax code. Before we've had about 12 separate taxes, and that ended up that ended up reducing the tax base and also created a lot of bureaucracy. So this uniform tax code will make sure that there's greater tax compliance. It'll increase the revenues of the government. At the same time, it'll increase the competitiveness of the organized sector against the unorganized sector.
So that was about GST. So the gist of it is that tax collection in India is going to be a lot easier, and it's India going to benefit the organized sector as opposed to unorganized players. So moving on to our topic for today. So I mentioned that today is all about the I in Cancelim. So today we're talking about what is our I, it's institutional sponsorship. We'll talk about why it's important as well, and we'll see how to use MarketSmith tools to find out how institutional sponsorship what institutional sponsorship is doing for that particular stock that you're looking at, whether it's good or it's bad, or is it selling off. So all those things we'll look at, and as well as we look at how do we find stocks that have institutional sponsorship that is increasing. We look at several charts where we see that heavy volumes come in as institutions start buying that stock, and then that results in strong price rises as well. Okay, so I is all about institutions who buy that stock. Most importantly, we are trying to focus on mutual funds. Mutual funds are people who they will do a lot of research into any stock before they buy it, and they are big players in the market, and they will typically drive any stock through their buying and selling activity. Other institutions are pension funds, hedge funds, insurance companies, banks. There are many institutions that play a big role in the market, but the biggest role by far is played by mutual funds. So how does it affect the stock? It's mainly the way it affects any stock that we're looking at is basically through their buying power and their selling pressure. Uh, they usually invest huge amounts because when you're talking about a mutual fund, it's basically pooled money of several individual investors, and there's one portfolio manager sitting there who's taking a decision that he's going to buy this particular stock for that entire fund. So which means it translates to a huge number of individual investors buying that stock, and all at once that too. So that means that there's a lot of buying power as well as there's a lot of selling pressure as well. So when they start buying or when they start selling, that will definitely have an impact on the stock. So here's a quote by William O'Neill. It's key to buy better stocks mutual funds buy, and it's avoid ones that they may be selling on a heavy basis. So trying to go against the flow of mutual funds, trying to go against that what we call as smart money in the market, that will only hurt our results. So we need to we always talked about how the market is our friend, and we are trying to follow the trend of the market here. So the same is applicable on an individual stock level as well. Whereas we are trying to follow the trend where when you have institutions buying that stock, we are trying to follow them, and when we see them selling it, that's when we are trying to get out. So as a general rule, we say that the stock should at least be owned by 50 or more funds. Uh, Most of the great winning stocks will have many more, but at least 50 is what we typically look for. Now, the reason is that this will give us confidence saying that at least 50 people have 50 portfolio managers who have experience in the market, who have very good research tools. They have looked at the stock and they have decided that this is a good fit for their portfolio. So in a way, they are doing their homework for us, and it's telling us that this is the quality of the stock is good enough for us to have in our portfolio, provided that there are so many others also holding it. So here's another quote: if a stock has no professional sponsorship, chances are its performance will be run of the mill. No sponsorship means that at least some of the more than 10,000 institutional investors have looked at that stock and passed over it. So what that means is that these institutions are basically they're doing some research on their own. So if they are willing to buy that stock, well, that's a good sign. If there's a stock that has no sponsorship, that means that a lot of funds have looked at it and decided that it does not have the quality characteristics that they want, and they don't feel comfortable adding it to their fund holdings. So that would be a warning sign, and we would always try to avoid such kind of names. More than the quantity, more than looking at how many funds hold that stock, it's also important to look at who exactly owns that. So if you see top performing mutual funds owning that stock, so that's giving you a sign that this is one of the stocks that is resulting in a good performance for them. So if you have any major investor whom you follow, say you like the investing strategy of Rakesh Jujunwala, if you try to track what kind of stocks he's buying or selling, that is automatically telling you that the stock that you're looking at is already passing through all his checklists. He's done his research already, and he's comfortable buying it. So that means that there's no harm in us buying it by ourselves. Uh, and there will be many investors who have different investing styles. So, for example, there is this fellow called Purunju Elliott who kind of follows a value strategy and he looks at small cap value stocks. So, if you're trying to kind of look at those kind of stocks, it's probably a good idea to look at his holdings and see what kind of stocks he has picked, and that would mean that it makes sense for you to hold them as well, provided that you are trying to follow that kind of strategy.
Because those investors have huge bearing on the market. Recently, in the last 3 years, the number of SIPs has doubled to 1.28 crores. So you can see in India, more and more retailers like you and me, more and more of us are investing personally and also approaching mutual funds and creating SIPs and investing money through mutual funds. So as we go on further and further, these mutual funds, the asset under their management will only increase, and the bearing on the market will only increase. So it's very important to track whether their institutional investors are shorting a stock or going long on a particular stock.
So this is something that we always look at when we are trying to screen a good increase or material increase in the number of funds holding that stock, especially in the most recent quarter. So here you can see this is we create a kind of table like this and then look at what is happening. So you can see over the past four quarters, the number of funds has increased. It's not any particular stock. This is just an example of what we would look for. So you can see, especially in the most recent quarter, the number of funds holding that stock has increased from 132 to 161, and it has been increasing in the past 2 3 quarters as well. So this is something that we always look for when we're trying to add stocks to the model portfolio. How many funds are holding it right now? How much has it increased in the most recent quarter? And for how many quarters has it been increasing consistently? So how does that translate to what you can see on MarketSmith? So we have this rating called accumulation distribution rating, or it's also known as buyer demand rating. It's basically a letter rating. It goes from A to E, and each letter corresponds to a specific level of buying or selling activity. So this rating looks at basically volumes in the market, and using volumes, it's able to determine whether there is a lot of buying demand or whether there is a lot of selling pressure going on. So here's what all the letters mean. A would mean heavy accumulation, B would mean moderate accumulation, C is a kind of neutral rating where there is kind of an equal amount of buying and selling. Anything below C indicates that there is more selling happening rather than buying. So basically it measures selling and buying activity over the past 13 weeks. So the higher it is, that is kind of reflecting that institutions are buying. As I said before, institutions, most of the volume in the market is coming through institutional investors. So if you see an A or if you see an E, any extreme that you see, it more often than not would indicate that it is an institution who is driving that kind of volume in the market. So here's what you can see in the checklist page when you're looking at any stock in MarketSmith. You can see the AD rating. It will show up as a letter over here. So A, B, even C is still acceptable up to some extent. So A and B would be pretty good. So you can see for this stock particularly, it is an A rating.
Yeah, it's a very quick way of ascertaining whether institutional investors are bullish on a stock or bearish on a stock.
So people might ask, won't it be late if you buy after after you already see that institutions are piling into that stock, or shouldn't we get in before institutions buy? Now the reason why we look at institutional holding the way we look at it now is that uh, we want to have the confidence saying that yes, institutions have been buying it for some time. They are confident holding it in their portfolio. They are confident in buying more of that stock. So that's why we look at increasing institutional rating. And why will you not be late? That's because institutions will typically build their position over several weeks or several months, because they are investing huge amounts of money. It's not just a one shot buy and sell that they do. So they slowly build their uh, they s- they would slowly build their positions over several weeks, several months, and that would mean that, even if you see institutional ownership rising, even if you see institutional ownership, can you please mute your microphones if you're not asking a question, because it disturbs everybody else who is listening in on the presentation. Okay, moving on. So why will you not be late? It's basically that they will take a lot of time to build up their position, and they will, if they like that story, it's probable that they'll keep building their position, and they're not going to stop buying it anytime soon. So they'll slowly keep buying more and more as the company's earnings come in, and as favorable earnings come in, and so on. So it's not that we'll be late by waiting to see the institutional sponsorship, and we'll see that in the following charts as well. So here is yeah, Page Industries has come up several times in our webinars. It's basically one of our biggest winners. And here you can see that before the breakout, the AD rating was A. So even right before the breakout, there was very strong buying volume going on. So you can see in the weeks prior to the breakout, the red bars which indicate selling volume is quite low, and the blue bars, especially in the weeks before the breakout, is very strong. And so that indicates there's a lot more buying happening rather than selling. And after the stock broke out, it ended up giving a huge return as well. So here's another example of Finolex cables. Here you can see that volumes are very strong on the breakout, and prior to the breakout as well, there is more of buying compared to selling. So you can see that AD rating was already an A for this even before the stock broke out. So it was already being accumulated, and it continued to be accumulated after the breakout even. So it gave a huge return of 394%. And here you can see the fund ownership as well. Number of funds owning the stock broke out sometime in December, and the number of funds owning the stock have been increasing prior to that as well. So here's what I was talking about. Big investors will take a long time. They'll take weeks, they'll take months to establish their position in a particular stock. So they buy over time. They basically give instruct their traders to fill in a certain number of position in their stock, and then the traders will execute that wish over several weeks and several months. And it's not just that. If they really like that stock, they will even buy more of it as time goes by, and as they come out with as the company comes out with better earnings through a few quarters. So as a retail investor, what that means for us is that we have the advantage of being able to get out and get in very quickly. So as soon as we see the stock breaking out, and institutions are already buying that position, and the stock has just broken out on heavy volume, that would mean that we can quickly get in one shot. And then once we get in that one shot, then as institutions keep building up their position, that basically works to our advantage. So we are already in just one day, and institutions will keep buying their position over several weeks, and they'll keep buying more when new earnings come out and so on. Yeah. And that will result in the stock going up over a long period of time.
So I'll just give you an example, a live example, why institutions keep buying over a period of few weeks or months. Recently, a couple of days back, the Employment Fund Organization, they took a call of investing their money in the stock market. They have increased their position from the existing 10% to 15%. So all the PF money that is going to the Employment Fund Organization, it will 15% of it will be it will end up in the stock markets. So that's not going to happen in 1 month and stop. Every month, people keep earning, keep contributing to the PF fund, and the money keeps flowing from that fund to the stock market. So that's why we say that big institutional buyers over a period of time, they keep accumulating in good stocks.
So here you can see the kind of fund sponsorship that leading stocks had, and keep in mind that this is before the breakout. So here you can see AIA Engineering. You can see how the fund ownership has increased in the 3 quarters uh, before the stock even broke out. So it's not like you'll be late if you wait for this to happen. And here's the chart for, so the stock gave a return of 183%, and the fund ownership was increasing prior to this breakout as well. And it broke out on heavy volumes, and then that resulted in a strong uptrend. It kept going up for a long period of time. Another example of Maruti Suzuki. This is how the fund ownership was evolving before that breakout. So you can see that each quarter it was increasing at a steady pace. And here's what the stock did after that. So prior to this breakout, we saw the fund ownership increasing. It broke out on heavy volume, and that breakout led to a very sustained uptrend. So what happens is people have been building up their position throughout this base. The stock breaks out, that leads to some momentum, and each time it pulls back, there will be institutions supporting it. So you can see each time it pulls back to the 50-day moving average, everybody who wants to keep building a position in the stock, they feel that now is the right time to add some more stocks to their position. So they add more, and that keeps pushing the stock up and up, and it leads to a sustained uptrend. So how do we check if you're looking at any stock? How do we see the institutional sponsorship for that particular one? So AD rating is one way. We typically say that C is a neutral rating, A and B is good. C is still acceptable, but we want it to be somewhere in A or B range. So this is the checklist portion in the MarketSmith application. And the same AD rating it's the same thing as buyer demand, known by two different names. Buyer demand will show up in the main screen, while in the checklist you can see the accumulation distribution rating. We have more tools coming up that will help you evaluate this. So we mentioned that when we do a screening, we look at what is the percentage change in fund ownership in the most recent quarter, and we also look at how many consecutive quarters of increasing fund ownership we have. So this is what we typically look at when adding stocks to model portfolio. We don't have this in MarketSmith at this point, but this is something that we are planning to add to the app sometime soon. So what this will do, it quickly tells us if institutional sponsorship has been increasing or not. So one way to quickly find stocks that probably have institutions buying them is to look at upon volume. So upon volume is basically telling you the stocks that are going up with heavy volumes. So if volumes are heavy, we already know that most of the volume from the market comes from institutions. So if something is up on heavy volume, that would generally mean that it's being driven by institutional investors. So upon volume gives you a big list, and you can just go through this list and look at how much do they fit in with the other canceling criteria. Yeah, so not all the stocks will have rising sponsorship. So, but many of them will. So upon volume, it can be driven by retail investors, but more often than not, when you see very heavy volume, that's mostly institutions buying that name. So we look at some charts as well where you will be able to identify that this kind of volume can only come from institutions. So here we'll be looking at a few charts. We'll see the spikes in trading volume that kind of hints at institutional buying and selling. So here you can see the Ramco Cements. This is the daily chart. So you can see these huge volume spikes. So basically the line here that you see is a 50-day moving average of volumes. And these huge spikes can only come from institutional holdings. Simply retail investors buying and selling is going to result in this kind of volume. So
we know for a fact that the retail participation in India is very few, or hardly a couple of crore people. So them pushing so many stocks, it's more likely it's from the institutional investors rather than the retail investors. So this is a very obvious clue. The institutional investors are buying these stocks in high volume.
So basically, if you are looking at it at charts, if you look at volume in charts, it's not going to escape you in any way. If you see institutional buying, it's going to be very evident when you look at that chart, just because the volume is going to be so much more above average. And here you can see how the stock kind of moved towards its pivot, but there was no big buyer kind of supporting it. So you can see that it broke out. Volume was actually a little above average, but not very strong. And you can see that it did not lead to any sustained uptrend, where the stock kind of was flat, and it consolidated a little bit more after it made this handle. But you can see as soon as heavy volume comes in, that leads to a sustained uptrend. So what is this telling you? It's basically that any action in the prices is mostly going to be driven by the people who can push this kind of volume in the market. So once the big players start coming in, you can see that volume is well above average, and that results in the stock moving up as well. And this is basically how institutions would build up their position over time. So you can see the 10-week moving average or the 50-day moving average here after this after the breakout from this particular flat base. So you can see each time it pulls back to that 10-week moving average, somebody comes in and supports that stock. So like we said, institutions will decide that this is a stock that they like, they want this in their portfolio, and they want to build up their position. Now, they won't build it up in one shot. They will add stocks as it keeps moving. So they'll add some stocks on the breakout. They'll keep adding a little bit, and as it pulls back, they'll decide that now is a good time to add a good chunk to their position. And once they do that, the stock will find support, and then it'll continue its uptrend. So that's what you clearly see here, where the stock pulls back to its 10-week moving average. Somebody decides that now is a good time to add more to my position, and that results in that uptrend continuing for several weeks. Here you can see the opposite happening, where institutions are selling that stock in a heavy manner, and that results in the stock really breaking below moving averages and resulting in heavy losses. So you can see that it works, both sides of the coin is there. So it can be heavy buying as well, it can be heavy selling as well. So in this case, it's basically everybody wants to get out of the stock. So selling volume is much above average, and that's leading to the stock severely breaking down. And this is where a lot of people can get trapped. They will see the stock breaking down, and they'll think that it's just not possible that it can go down so heavily. The value in this is so good now that it's bound to come back sometime soon. But what they fail to realize is that who is really selling the stock. The people, if you just look at volumes, you realize that it's institutions who are selling the stock. And what that means is they are seeing something in the stock that they really don't like, and that's why so many people are selling at the same time, and everybody wants to get out at the same time. Uh, so when that happens, it's not likely that they'll change their mind anytime soon. They would have done their research before doing this. So it's unlikely that the stock is going to come back and start rallying again. It's going to take some time. It'll fall, it'll consolidate, it'll make a base, and something new has to come out in the story of that stock for people to get interested in it again. And then finally, it'll start making up moves. So these kind of selling it's always a warning sign for us. We always strive to get out before we see this kind of thing happening in the chart. And of course, even if we thought it was a good company and this kind of selling happens, you should not be worried by that, because you can always buy it back later. You can always buy it back when it looks attractive, when the volumes are there again, when you can see that institutions are coming back to support that stock. So just because you've identified something does not mean that you have to buy it now. You need to look at the chart and see what are the big players in the market doing. Are they supporting it, or is there heavy selling going on right now? So you can always buy it back when the stock is showing strength. So when would we want to get out? Ideally, we would want to get out before this kind of drop happens. So here you can see it breaks below the 50-day moving average quite sharply, whereas in two prior instances, it pulled back near its 50-day moving averages and then found some support. But on this instant, that did not happen. So that would be a warning sign for us. And also it closed at the bottom of the week's trading range. So this bar would represent the trading range for that particular week. And for that week, it closed near the bottom. So two warning signs for us: very clear break below the 50-day moving average or 10-week moving average, and closing at the bottom of the range for that week. So this might cause us to get out of this position, and that will save us from this kind of selling. So this is a dash for the exits that you see. Big institutions, they want to get out quickly, so they might have a good reason for getting out of the stock very quickly, and we don't want to get trapped when that happens. So of course, the huge volume spike, this shows that it's institutions who are selling the stock. Notice that in the prior instance, when it found support at the 50-day moving average and bounced back up, that also happened on huge volume spike. So you can see that institutions were supporting it here, but suddenly here they are not supporting it anymore. So it's quite clear when you look at the chart what are the institutions doing with the stock. Some of the key points from today. Today was all about the I and why institutional sponsorship is important. Uh, we want to see mutual funds, institutional investors, well-known individual investors who we know are kind of gurus of the market. We want to know that they have the confidence to hold the stock. So we want to see them buying the stocks that we are looking at. We want to see the institutional sponsorship increasing as well. The reason is because a few reasons. One is because they account for a bulk of the trading volume. So any price moves up or down that you see in the market, that is going to be purely based on support coming from institutional investors. Uh, Another point is that if you see that they are holding that stock, it's kind of in a sense they're doing their homework for us, and it's giving us the confidence that if they are comfortable enough holding that stock and building up their position in that stock, then it's good enough for us as well. That's about it for today's session. A fairly simple session today. We are only talking about the I in calculum and why that is important. We also looked at a few charts about how we could identify heavy volume coming in and how that is a sign of institutional buying. And we also looked at one chart where there was heavy selling, and that was basically a dash for the exits by institutional holders. Uh, Next, we look at how we approach diversification and what is our take on diversification at MarketSmith basically. How many stocks should you hold in your portfolio, and how it is important to study the chart and basically understand how that stock has been trading historically, and how to identify when the personality or the character of that stock has changed just by looking at the chart and by looking at how it has traded historically. So if you can spot a chart that has been trading flat for a long time and suddenly starts moving up, so that's basically a personality change. Or if you see a stock that has been moving up for some time and then it starts breaking down, that's again a personality change. So we look at all those things and we look at why that is important. So all those things will be coming up in the next session. And so before we end today, we'll take a few questions and we'll see if today's session, the message of today's session was clear. So prices falling on below average volume. So there are a few things you can infer from that. So one thing is that first of all, it's low volume, so institutions are not buying it right now. They are maybe waiting for a better price. They are maybe waiting for the earnings to come out. They could be waiting for one of the company presentations, analyst conferences, where they are kind of staying away from that name for a given period of time. Uh, Generally, price falling on low volume, we don't see it as a negative sign as long as it is above the support levels that we have identified earlier. So if we identify that the stock has historically traded above the 50-day moving average, and now the price is falling toward the 50-day moving average on a lower volume. So that means that we would still be confident at that stage. So we would say that it's pulling back towards support, and we would expect that as it hits the 50-day moving average, some buyers would start coming in, and you would see the price moving back up on, yeah, on higher volume. But if you see that it's breaking below the support and still the volume is low, that would kind of mean that uh, people are really not looking at that stock. So it is breaking below support and nobody is coming in to support it. So that would be a little bit worrying sign. So in that case, we would evaluate whether it is time to get out of that position or maybe reduce some of our position if we see something like that happening. So when we talk about support, always what we want to see is as it hits support, somebody comes in with huge volume and starts buying it again. Okay, so going up on huge volume and then going back down on huge volume. So basically that is, people are not sure what to do with it. So in that case, we don't really get a clear picture. This sometimes can happen after earnings updates where it was kind of a mixed update where something was above consensus, but yet something else was not as expected by the market. So in such situations, these kind of volatile things will happen where people are not really sure whether it was a positive news or is it a negative news. So in these cases, it's best to identify where are we going to get out of the stock. What is our support level that we are looking for, and we'll say that below the support we don't have confidence anymore, and then we are going to get out. As long as it is above that, we'll say that let this churn kind of play out, and we'll see over the next few days where it heads up. Of course, it's a good idea to analyze whatever news has come out on your own and make your own conclusion as to whether is that positive for the stock or is that negative for the stock. Uh, so when you see this kind of thing happening, it's best to wait and watch to see how it pans out. But that said, you should always keep your support level in mind, saying that this is where I know the stock should find support. If it falls below that, I'm going to get out of my position. So that is something that you should always keep in mind.
We have a question here, and by Mr. Mohan. He says that why not just own the stocks, common stocks owned by the top 10 mutual funds? Why analysis is required in the first place? It's important to know that every investor will have different return goals. Some people are investing a lot of money and they want a very stable returns, and the time period of the returns differs. Some people might want stable returns for a longer period of time. Some people want higher returns in a short period of time. The risk profile, the risk that they can absorb varies. So it so in so it's important to know that it's about what you want. Many of the mutual funds, they invest in companies like ITC and all these large cap blue chip stocks, which don't really move a lot because they're mature companies, they're stable companies. So we can't just buy those stocks and make really good money out of it. So that's why we need to research further, and depending on your return appetite, what you want, and the time period that you want the money. So it depends on that. So we can't just simply go by the top 10 stocks owned by the top mutual funds.
That's it. It's a good starting place actually. If you just look at the stocks owned by the top 10 funds, provided that they are following a growth strategy, because we are trying to look at growth strategies here, and that gives you a starting point to, okay, these are the kind of stocks that look interesting. Let me research them and find out whether it fits what I am looking for in the kind of stock that I want to have in my portfolio. So everybody has a different investing mandate as well. And apart from that, we also want to see institutional holding increase as the quarters go. So each quarter, as the earnings come out, we want to see more and more funds buying that stock as more and more funds get convinced about that story. So that is something that we look for. Okay, so depending on your risk appetite, so if you have a low risk appetite, you should be looking at a little bit higher market cap companies, a little bit more well established companies. Fund ownership will also help you in that sense that if you see a lot of funds holding that stock, it's probably not going to be so volatile. Uh, it also depends on how what is your conviction level. If you are really confident in a name, in that way the risk is low, right? So if you are so convinced about the story, then you could say that the risk in that buying that would is relatively low. Whereas if you have a little bit low conviction, someone who has a high risk appetite might buy stocks where they have 60% conviction, or 70% conviction and so on. And so somebody with a low risk appetite would be very, very selective in what stocks he picks up.
And also by looking at the charts, you can find out how volatile stock is. For example, companies like HUL, Colgate, if you look at the charts, usually they trade in a very tight pattern. That means the opening close high price it won't be too far off from each other. So by looking at the chart, also you can get an idea that these stocks are not so volatile. And generally, blue chip companies with very stable, returns, sales growth, and earnings growth will depict such will have such charts where they trade in a where the stock trades in a very tight pattern.
So when it comes to volume, what parameters of volume do we look for? So in our charts, we will always have the 50-day moving average of volumes as a line, and you will see the volume bars either above that line or below that line. So that is telling you how much above average the volume is. Uh, there are several ways that we look at volume. One is when the stock goes up, we want that to happen on high volume, which is in a sense it's saying that it is going up because institutions are accumulating that stock. And like I just said a few minutes back, when it goes down, we want to see it go down on low volume, which means that it's only a few retail people who are exiting that stock for whatever reason, and it's going to find support, and then it's going to go up on high volume. So that is something that we look at.
And on the buy side, why we stress on high volume is, so whenever say the volume say for the day is 100 million or whatever, the 100 million includes the also includes the number, the seller selling the stock. So it just does not include only people buying it. So when at the end of the day, when the stock goes up on higher volumes, it means that some of the weaker investors, some of the bearish investors are getting shaken out of it. That means they're coming out of the stock. That means if the stock is going high on volume and consistently that it shows in the charts, that means that weaker bearish investors are also getting shaken out of it. That means it's likely to go up, in the future.
So I think we covered ROE a little briefly in one of our prior sessions. Our thumb rule that we follow is we want at least 17% ROE for any stock that we look at. That said, of course, the higher is better. And when you're looking at any fundamental characteristics, let it be ROE, margins, EPS growth or sales growth, it always needs to be analyzed in the context of that particular industry. So if you're looking at ROE, you need to answer the question, is this ROE very good for this particular industry, or is it in line with the rest of the industry?
Yeah. For example, in industries like metal, etc., you can't really expect an ROE of 30 or 35. In most usually it'll be below 20, and even ROE of 12, 13, it's pretty good in capital intensive industries like say metals, etc. So it depends from industry to industry, but as a thumb rule, we say at least 17%.
Okay, I think you were asking about ROE of that we actually mentioned in the starting. If I can find that quickly. Yeah, so year to date, our return is basically 27.63%, and that has given us an alpha of 10.41%. And this is just a year to date calculation. So since 2017 started, this is the kind of return that we've had.
We have a question here asking, does Avanti Foods qualify as a cancer? We need to have a closer look at the charts, and maybe we can, you can write to us. We can definitely give you a response.
I would suggest for your stock specific questions, you can just write to us, and
Yeah.
then
Yeah.
we can have our team work on it.
Yeah.
Rather than trying to answer them on the spot.
Mhm. Just my email. Yes, by email. You can reach to us. I'll just type it out. Just hold on a minute. Another question, are we aiming at 50% per annum? Well, it depends on the markets too. For example, last year the markets weren't that great. So generating an alpha of close to 50%, it may not be conducive. So it depends on scenario to scenario. So as of now, we are at 27%. We definitely would like to, based on the market condition, would like to increase our alpha and our total returns. So you can write to us at marketsmithindia@williamoneillindia.com. We've typed it out for you. Well, we started investing in the Indian market since 2009. Uh, Approximately, our CAGR growth of our portfolio is about 20% per year per annum from 2009 till now.
Somebody is asking for presentation. YouTube video will be there for recording. Somebody is asking for presentation.
The CAGR is about 20% over the last few years. Uh, any more questions? Yeah, this will you will have access to this presentation and the audio file too, right?
Yeah, there will be a, this is right, this is being recorded right now, and you will be able to view the recording on YouTube.
What is that?
So delivery volume, so it is basically telling you how many stocks are actually for, through cash trading, and how many are through derivative. How many, it's kind of, in a sense, it's telling you how much volume is coming from speculators and how much volume is coming from people who actually want to hold that stock. So typically we would say that we want more people buying that stock to hold it rather than trading in options. So if you can see that there is a very high delivery volume and it's much higher than the average over the past 50 days, that would be a good sign provided the stock is going up. If it's going down that way, that would be a negative sign. And yes, past presentations, whatever webinars we've conducted so far, all of them are available on YouTube.
Any more questions? Talk about how we are. We are planning to invest.
I think all these issues, it would be best to write to us, and we'll have our marketing team get back to you on these kind of arrangements. Thanks, Suresh, for sharing that link. So that's basically where you can see all our past webinars. Okay, so if there are no questions, I think we'll end today's session. Thanks all for joining us today, and thanks for listening in. Please do check out our app if you haven't, and stay tuned. We'll have another session in the next 2 weeks. So we conduct this on a bi-weekly basis, and we hope you'll join us for next time as well. Thank you.
Yeah, thank you.